Hi, welcome back. In a previous session, I drew a contrast between growth and value investing. And I argued that growth investing is about investing in younger companies, and value investing, at least as we know it, has become investing in older, middle-aged, and declining companies. Nothing inherently good or bad about either, but in this session, I want to focus on value investing. Let's set the table. When somebody tells you that they belong to the value investing school, it's good to push back because there are three broad variants of value investing. The first is what I call passive value investing. What do passive value investors do? They screen companies for cheapness, low PE ratios, low price to book, perhaps add other variables. This is a carryover of the Ben Graham approach to value investing. Look for stocks that look cheap by screening for them. The second group of value investors I call contrarians. What do? They buy stocks that are beaten up perhaps after a bad earnings announcement, beaten up because the market has turned against them. And the third group of value investors I call buy and hold value investors. They look for good companies, they put their money in good companies, and then they forget about them because their argument is, in the long term, good companies are good investments. So I'm going to start with why I think value investing is so appealing to people. What is it that draws people to value investing? And then talk about each of these schools of thought. Do they actually work in practice? Let's start with the appeal of value investing. If you remember at the start of intrinsic valuation, I said a good valuation is a bridge between stories and numbers. That when you connect the two, your sales pitch becomes stronger. In many ways, value investing is both a story side and a number side that appeals to people. What's the story side? The story side comes from legendary value investors. Let's take the most legendary value investor, Warren Buffett, and Berkshire Hathaway, the vehicle that he's used as his investment vehicle. In this graph, you can see the returns you'd have made investing in Berkshire Hathaway going back to its inception over time. And it's no contest. If you'd put your money in Berkshire Hathaway rather than the S&P 500, you would have made about 100 times more money by the end of the period because of the higher returns that Warren Buffett has delivered. Now, as a consequence, not only do we read books about Buffett and why he's been successful, when he has his meetings, Berkshire Hathaway meetings, it's become the equivalent of value investing Woodstock. The story side basically is about the legends and their winnings. I mean, we still talk about Warren Buffett buying American Express when it was beaten up after an Italian salad oil scandal in the 1960s. So the story side is about great value investors and how they've succeeded. And there's a number side. The number side, surprisingly, has come from academia. It comes from studies that started in the 1970s, where analysts or researchers looked at low price to book stocks and high price to book stocks. They classified stocks based on price to book ratios, and they looked at the returns it had made over time. This table, or this graph, which is updated through 2022, shows you the payoff you'd have had from investing in low price to book stocks. The lowest price to book stocks have delivered much higher returns than the highest price to book stocks. The performance is far better on an equally weighted basis, which means it's the smallest low price to book stocks that actually deliver the highest payoff. And you can see that over time, low price to book stocks have beaten high price to book. This is often at the basis when people talk about the success of value investing, is that low price to book stocks and low price earning stocks historically have earned much higher returns than high price to book and high price earnings ratio stocks. We're going to push back against this, but the story and the numbers have kind of fed into the mythology that value investing is special, that it's more likely to succeed. Now, incidentally, it's worth noting that the academics who presented this research on price to book, in particular Farmer French, the study we've talked about in previous sessions, that 1990 study that found that returns were higher for low price to book stocks. Gene Farmer and Ken French were very clear that they didn't think of this as evidence of market inefficiency, that you could make money. They viewed it as a misrisk, that something in low price to book stocks made them riskier, that traditional finance risk measures were not capturing the risk. So one view of these studies, which look at the past and find that low price to book stocks earn higher returns, is it's a proxy for risk. The other view, which is what active investors have taken and run with, is that it's evidence of market inefficiency. And you can tell a story. Maybe low price to book stocks are boring companies and investors want action and danger and they go seeking it out. But that becomes the basis for the value investing push. We're going to be value investors because we can do much better than the market. So let's do the pushback on this. It is true that if you look at that long history, low price to book stocks have beaten high price to book stocks. You can't contest it. Statistically and economically, that difference is significant. But if you look at the 95 years of data in there, and you look at how many years low price to book stocks outperformed and how many years high price to book stocks outperformed, it's surprisingly close. In 50 of the years, low price to book stocks did better. In 45 of the years, high price to book stocks did better. What does that mean? It goes back to what we talked about during the growth session. When you're a growth investor, you're not arguing that high price to book stocks do better than low price to book over the long term. You're arguing that you have a timing advantage. You know when to buy high price to book stocks, and growth stocks and clearly win often enough that if you are timely in when you buy and sell them, the high price to book stocks might deliver higher returns. Second, if you look at the payoff to active value investing, because remember that chart of low price to book stocks is not evidence that active value investing works. It just means that low price to book stocks do better than high price to book stocks. Active value investors would blanch at the idea of just putting the money in low price to book stocks. In fact, the essence of value investing is you go further. You look at great management, you look at the accounting returns. So it's not just price to book, you do additional work which costs you time and costs you money. So the question then becomes, does active value investing work? And there's a very simple test you can run of it. Remember, you can create index funds based around price to book ratios. You can buy the bottom decile of stocks, take the bottom decile of stocks in terms of price to book, and create an index fund that owns just those stocks. In fact, there are those index funds available if you go to Vanguard or any of the index fund operators. The question is, do active value investors beat the value index funds? In other words, the additional work you put in as active value investing, does it deliver higher returns than just buying low price to book stocks? And there, it turns out that the evidence is mixed. Some of the earliest studies seem to back it up that active value investing worked. One of the most famous and quoted studies of all time is a study by Henry Oppenheimer where he used the Ben Graham screens that go back almost a century now to find cheap stocks. And at least on paper, he found that screening for stocks using the Graham screens delivered returns of about 29% a year, well above what the index earned over that period. But that was between 1970 and 1983. And it was a small sample. It's not clear that you're actually going to be able to expand on this study. There are other studies since that have looked at active value investing, but they all have two issues. One is trying to separate how much of what they claim that active value investors make from what you could get automatically by just buying an index fund. So ultimately, that's why I argued that to check for active value investing, you cannot compare your returns against the S&P 500, because then buying low price to book will, at least in terms of history, outperform the S&P 500. You have to compare it to a value index fund. And when you do that, the numbers start to get trickier, and we'll come back and look at them. Let's take a look at the contrarians. The contrarians again argue that you should buy beaten up stocks. The argument, of course, is premised on the notion that markets overreact. They push down stocks too much after bad news. One of the earliest studies backing up the contrarians came out in the mid-1980s. And here's what the study did. It took the biggest losers over the previous year and it bought stocks in the biggest losers and the biggest winners. And it compared what you would make on the biggest winners and the biggest losers in the following year. So you pick the winners and losers based on last year, and then you see what you make in the next year. And what it found was astonishing. The loser portfolio significantly outperformed the winner portfolio. They concluded, therefore, that it's better to buy losers than winners. It's a classic contrarian strategy. And that result held up for a few years until people started pushing back. One of the caveats on that finding was that If you held through 12 months, it looked like the losers beat the winners. But if you held for longer, 5 years, all of those excess returns you thought you'd make would disappear. In other words, it depends on your time horizon. Second, if you look at the loser stocks, it turns out that a large percentage of those loser stocks, remember these are the stocks that have been beaten up the most in the last year, trade at $1, 70 cents, 60 cents, trade at less than $1. You're saying, so what? The transactions costs of trading on stocks that are that cheap, that low priced, are very high. And if you correct for those transactions costs, it turns out that those returns you saw in the previous graph again start to dissipate. So if you're buying loser stocks based on the original study, you might want to rethink that, because the evidence seen seems to suggest that it doesn't hold up. So you've got the value screeners, and the question there is, do active value screeners beat a value index fund? You've got the contrarians, and while the initial evidence backed them up, it turns out as you dig deeper that it's really difficult making money as a contrarian investor. And then you got what I call the value indexers. What are indexes? Remember we talked about index funds. In an index fund, you buy every stock in the index. So the S&P 500 index fund buys every stock in the index in proportion to its value in the index. And since the S&P 500 is a market cap weighted index, the biggest companies are going to be weighted more. You know what value indexes do? They take an index fund and they tilt it. Tilt it towards what? Towards those things that have delivered higher returns in the past. If you know, going back again to the Farmer Friend study, which found that low price to book stocks and small companies earned higher returns than high price to book stocks and larger companies. If you're tilting your index fund, you start to weight smaller companies in the index more and larger companies less. You weight low price to book stocks more than their actual market cap. In other words, you're following the index fund approach, but you're tilting the index fund towards things that you think will deliver higher returns. The argument that these tilted index funds make is they deliver all the diversification in the index fund, but they allow you to make a little more than the market. And in terms of risk-return trade-off, that should show up as a much better return for any given level of risk that you take on. I personally believe that a tilted index fund is an oxymoron. You're either an index fund or you're not. The minute you start playing with the weights and tilting them towards things that you will deliver higher returns, you're an active investor. Might as well call yourself that. And the question is, do these these tilted index funds actually beat the index? The evidence is surprisingly mixed. If you looked at that graph of price to book ratios over time, you might say, well, why doesn't that show up in the tilted index fund? As we'll see in the last few years, even that historical artifact of low price to book stocks earning high returns has come under assault. And this is now a good time to talk about what the 21st century has brought us. What I've done here is looked at just the top decile and bottom decile in terms of price to book ratios. So basically I broke all US stocks into price to book ratios, took the lowest price to book stocks and the highest price to book stocks. I have to give thanks to Ken French, who maintains an incredible database of this that I've used to come up with these numbers. What you see here is the lowest price to book and the highest price to book deciles comparison going back to almost a century. Let's go back to 1930 through 39. The lowest price to book stocks delivered on average 6.04% a year. The highest price to book stocks delivered 4.27% a year. The difference is 1.77%. 1940 through 49, lowest price to book stocks had an incredible decade, delivering 15.53% over. In fact, you could argue that almost the entire 20th century was an incredibly successful one for low price to book stocks. This, after all, is at the heart of the value investing mistake. But I don't think I'm being picky here when I look at the post-1990 time period and say something has changed. It's true that 2000 through 2009, you saw low price to book stocks again outperform. But in 2 of the 3 decades, low price to book stocks have underperformed the highest price to book stocks. We've never had a decade before that where that happened. In fact, the most recent decade, 2010 through 2019, was the worst in history for low price to book stocks in terms of performance relative to high price to book stocks. We'll talk about the value investing excuses for this and perhaps probe a little deeper, but clearly something has shifted in the last 2 or 3 decades. As for the question of do active value investors win? Remember I said the right test for this is not to compare the active value investors' returns to the S&P 500, but to compare them to an index fund. S&P actually maintains a site called SPIVA. And it's incredibly useful because what they do is they take active investors in every style class and compare them to an index fund in that style. So what they've done here is they've taken value investors, active value investors, and compared them to the index fund and see what percentage beat the market. So if you look over here, and they've broken down these funds because you can have small cap value funds, mid cap, large cap, multi cap. In every category, the numbers are striking. More than 50%, well over 50%. In some cases, 70, 80, even 90% of active value investors underperform the index. If active value investing is adding value, you don't see it here. So when people talk about active value investing and they use the low price to book table that you saw, over history, low price to book stocks have earned higher returns. That's not sufficient. That's an argument for buying a low price to book index fund. It's not an argument for active value investing. And Warren Buffett himself has started to see a fading premium. There's a way in which you can back this up. We talked about the vehicle Warren Buffett has used for much of the last 50 years, more than 50 years, to deliver his stock picks, which is Berkshire Hathaway. Berkshire Hathaway happens to be an insurance company with a closed-end mutual fund. Every insurance company, that's true, but the closed-end mutual fund was run by a man called Warren Buffett. Legendary investor, right? And the way this manifested itself is if you looked at the price-to-book ratio for Berkshire Hathaway as a company and compared it to the price-to-book ratio of a typical insurance company. Berkshire Hathaway used to trade at an immense premium. In December 2009, if you go back all the way to December 2009, Berkshire Hathaway traded at a premium at a price-to-book ratio of 1.54. The typical insurance company traded a price-to-book of 1.10. That's a premium of almost 40%. If you go back to the 1990s, it's even higher. The premium has been fading. In fact, by the time you get to December 2019, Berkshire Hathaway was trading at a lower price-to-book ratio than the typical insurance company. The closed-end fund premium that you saw at Berkshire Hathaway has largely dissipated. Now, don't take this as a critique of Warren Buffett, but there are 2 things that are happening. One is that the market is factoring in the reality that Warren Buffett is aging, that he can't be the active money manager anymore. And no matter how carefully he picks his successors, it's impossible to replace a legend. The second is, and this goes back to the table you saw a couple of pages ago, something seems to have happened to value investing, at least as practiced in the 20th century, where it doesn't seem to be working as well anymore. So not only are active value investors having trouble beating their index fund, beating a value index fund, but the Buffett premium is starting to dissipate. Value investing is in trouble. I don't think that even the strongest defender of value investing is going to argue about that. The question is why. The first explanation is that this is a passing phase. I mean, after all, value investors are noted for having long time horizons. Their argument is, this too shall pass. We're going to come back on top. After all, there have been other periods in the past where value investing has underperformed. True, but not for as long as we've had over the last 30 years. This is too long a time period to be a passing phase. No, I can't rule it out, but I don't think you want a passing phase that lasts decades. The second explanation I've heard is to blame the Fed. The Fed is an easy entity to blame. And the argument here is that the Fed has kept interest rates at abnormally low levels. And by doing it, they've allowed growth investing to exploit risk capital as an advantage. And that's why value investing is failing. So I think if this is true, if the Fed loses control of rates and rates rise, value investing should return. Well, since 2022, interest rates have risen. Value investing still hasn't come back. So maybe it will, but no, the Fed did. It seems very convenient, but I don't think it fully explains what's going on. The third and the fourth explanations are the ones that I think best work. The third explanation is that the investment world has become flatter. Let me explain what I mean by this. 50 years ago, if you wanted to run the Ben Graham screens, it took a lot of work. In fact, when Ben Graham came up with the screens in 1950, running those screens would have been an immense amount of work. Remember, you had no database, so you'd have had to collect the data by hand. You'd have to compute every ratio by hand. There's no automatic sort. You'd have to sort by hand. So to find the companies that passed your screens would have been an excruciating exercise. But that was good because the people who did it had an advantage over the rest of the market. Today, you know how long it takes to run a Ben Graham screen? And I could take Capital IQ, which has a database of all publicly traded companies, and automate the Graham screens to run in a couple of minutes. This is great, right? But there's a disadvantage. If you can run these screens and get stocks that look cheap in a couple of minutes, where's the competitive advantage? What makes you think you can make excess returns doing something that other people can do in a couple of minutes? Many of the things that value investors do has become so easy to do. The question you have to ask is, what is it you bring to the table? And if you don't bring anything to the table, why should you walk away with an excess return? The other thing that I think has changed is the global economy has shifted. First, it's become a global economy. For much of the 20th century, the US was the global economy. What happened in the US drove the global economy. Those days are done. The US is still the largest economy, but it doesn't dominate the global economy. Second, we're all connected at the hip. And third, if you look at the types of companies that have gone public in the 21st century, and we've talked a little bit about this in earlier sessions, they're very different from the companies of the 20th century. And I think that's putting value investing at a disadvantage. Value investing doesn't really know what to do with technology companies. It doesn't know how to deal with them. It doesn't know what makes them cheap. And that puts it at a disadvantage. So let's talk about value investing. Is there a chance back? Can you invest in middle-aged companies still and make money? I think value investing is in trouble for three reasons. One is it's become incredibly rigid in, what investors are supposed to do, things you can and cannot do. There's a lot of finger wagging in value investing. It's become very ritualistic. There are things you're supposed to do as a value investor. Like what? Like read Ben Graham's security analysis, an excruciatingly boring book. I mean, my books are boring, but Ben Graham's books are really boring. You're supposed to go to Omaha every year. You're supposed to read every word that Buffett says and view it as the truth. It's rigid, it's ritualistic, and to round it all off, it's very righteous. Value investors think they're the chosen ones. They think that they're the only ones who do the work that deserve excess returns. They look down at the rest of the investing world and they view traders as essentially shallow people who really don't know what they're doing. That's not a good place to be in investing. Rigid, ritualistic, and righteous, if that sounds like a religion, that's basically what old-time value investing has become. And God help you if you deviate from what value investing views as the right pathway. Now, as I said, there's a third strand of value investing, which is buy good companies. How do I know what a good company looks like? Well, you can start with profitability and argue that good companies make a lot of money. The only problem is dollar profits are going to be greater for bigger than smaller companies. You got to scale the profits to something, to revenues, to capital invested. But you could look at profitability. But let's face it, There are lots of companies where you're endowed profitability. There's nothing you're doing as a company that adds to it. You're Aramco, you're going to be incredibly profitable. Why? Because you have access to oil under the ground at a cost much lower than your competition. You could look at growth and say, look, I like good companies grow faster. But neither profitability nor growth tells the whole story. There's a third measure you can use. Good companies don't just deliver profits, they deliver returns which are much higher than their cost of capital, excess returns. We've talked about excess returns in other contexts. It could become a proxy for what companies are good, what are bad. You could even bring in qualitative factors. After all, Warren Buffett has talked about how he cares about the quality of management. But let's say you've come up with a way of measuring good and bad companies. Can you make money off that, assuming that you have a good basis for what you've done? It depends. Saying depends on what? It depends on what the market thinks about that company. Let's say you assess a company and think it's a good company. But the market also thinks it's a good company. You know what? If the market thinks it's a good company, it's going to price it as a good company. So when you go out and buy this good company, you're paying a fair price. The essence of investing is to find mismatches between what you think about a company and what the market thinks about the company. If you think about the expectations game, here's how it plays out. Let's suppose you come up with your expectations for the company and you look at what the market's expectations are for the company. If your expectation for a company is it's going to be a very good company and the market thinks it's going to be a bad company, you should buy the company. If you think your company is going to be a very good company, but the market thinks it's a great company, which is better than very good, you should sell that company. So if your expectations are running ahead of the markets on a company, and assuming you're right, those are your buys. If the market's expectations are ahead of your expectations for the company, those are sells. And if they match up, they're neutral. Neutral investments are not bad. They earn their fair rate of return. And assuming you have a neutral investment, great, great, good, good, bad, bad, you probably should go with the great, great. It's better to buy a neutral investment in a great company than in a bad company. But investing is about finding mismatches between what you think about the company based on your assessment of the company and what the market attaches as its assessment of the company. So let's talk about screening for value, assuming that's the way you're going to go. When people start to screen for stocks, they look at what other people have used. But I'm going to suggest a much simpler, more intrinsic value approach based to screening. When you think about the value of equity, and this goes back to the valuation session, the value of equity in a company, using the simplest valuation model I can think of, a dividend discount model, it's expected dividends next year divided by the cost of equity minus the growth rate. It's called the Gordon growth model. It's an old-fashioned dividend discount model. I agree, it's designed to value stable, mature companies. But I'm going to use it in a different context. If I divided both sides of that equation by the earnings per share, I end up with an intrinsic value equation for the price-earnings ratio. You say, where is this going? Take a look at that intrinsic value equation. The price-earnings ratio for a company is a function of its payout ratio, its cost of equity, and its growth rate. I have the variables that drive the PE ratio, and I can go further. If I increase the growth rate, my PE ratio goes up. If I increase my risk, I push up my cost of equity, my PE ratio goes down. And if I increase my payout ratio for any given level of growth, I'm delivering the growth more efficiently, my PE ratio goes up. So if I was screening based on PE, here's what I want. I want a low PE ratio, that's a cheap company. I want high growth because I don't want anything that explains away the low PE. So I want low PE, high growth. I want low risk. And I want a high payout ratio. So the essence of screening is not just looking at what the pricing is, the PE, the price to book, but to look at the other variables to see if they're going in the right direction. In fact, here I've taken 6 multiples: price earnings, PEG ratio, price to book, EV to invested capital, EV to sales, and EBITDA, and looked at the combinations that would give me a really cheap company, solid with PE, and a really expensive company. A really expensive company would have a high PE, low growth, high risk, and a low payout. And you can see this play out with every multiple. You have a template for screening. You want to screen stocks for price to book. You want low price to book. You want high growth. You want low risk and a high return equity. You want to screen stocks for for low EV to sales. You want low EV to sales, high growth, low risk, and a high margin. Investing is about finding mismatch, and I hope you can use this to come up with the screens that work better for you. In fact, if you're looking for investing lessons, it's not about buying great or good or bad companies. It's about finding companies where you find a company that is essentially a good business, and you're also trying to find management that is a good management, a pricing that's working in your direction, and that's going to drive your investment. So if you find a good company where the managers are good, the pricing is right, it's an emphatic buy. At the other extreme, you find a bad company, it's a bad management, it's overpriced, it's an emphatic sell. And in the middle, you have all these other choices. So what I'm suggesting is screen for companies, take a look at the management, but make sure you look at the pricing. At the right price, you should be willing to buy any company. At the wrong price, even the greatest company on the face of the earth should not be your investment. So at the risk of being viewed as, punching above my weight, I'm going to suggest that value investing, if it wants to survive and prosper, has to find a new paradigm. And here are my suggestions to value investors. First, be clear about the difference between value and price. True intrinsic valuation requires you to get your hands dirty with cash flows, growth and risk, understand business, tell stories, but it's a lot of work. Much of what I see in value investing right now is pricing. There's nothing wrong with it where you screen for cheap companies, but be clear about the difference in value and price. Second, value investing has this deep built-in aversion to uncertainty. This goes back to Ben Graham, and who can blame Ben? He came out of the Great Depression, and after you came out of the Great Depression, you wanted to push uncertainty away. His view was you want to avoid uncertainty. And that's become a driver of value investing as we know it. Unfortunately, that's not a great basis for investing. Through all of these sessions leading up to this one, we've talked about uncertainty as a feature, not a bug. You can't make it go away by not looking at it. Look it in the face, make your best estimates, be okay being wrong. In fact, all through these sessions, I've argued that your biggest opportunities, the companies where you're going to see the biggest mistakes, are where you're most uncertain. So rather than avoiding uncertainty, you got to try to seek it out. And I'm going to also take issue with another value investing precept that I see talked about all the time. It's called margin of safety. What's a margin of safety? It basically says that you value a stock, you want the price to be at least 30%, with a 30% margin of safety, at least 30% below that value. You're saying, what's wrong with that? That's great. Margin of safety does create a buffer. And it does protect you from buying a stock that's really overvalued because you screwed up on the valuation. So it does protect you against those stocks that are overvalued, that you might have bought because you thought they were undervalued. But like everything else in investing in business, there's another side to the trade-off. By having a higher margin of safety, you're not buying stocks which are undervalued because you put that margin of safety in. Whichever side wins will determine whether margin of safety works for you. And there's a very simple test of whether you should be using a margin of safety, or if you're using one, whether you should reduce it. Take a look at how much cash you have in your portfolio. If you're sitting on 30, 40, 50% of your portfolio in cash, why are you using a margin of safety? By using a margin of safety, you're effectively finding nothing to buy. You're sitting on cash. If on the other hand, you're fully invested, you have lots of things to invest in, by all means, put in a margin of safety. Whether you have a margin of safety or not is not either or. It depends on who you are as an investor and what kind of opportunity set you have. When markets are richly priced, you can't afford to have a margin of safety. When markets are incredibly cheap, everything is cheap, of course you can have a margin of safety. So value investing needs, I think, a reset. And whether it can pull it off or not is going to be, it's anybody's call. And there's one final issue with value investing, which I think we need to confront. Value investing, as we know, it is very heavily dependent on trusting accountants to give you the numbers. Trusting accountants on what? Earnings, right? They come from financial statements. And let's face it, companies have become much cleverer about the way they manage earnings. There's a lot of earnings management, not fraud, but earnings management. The second is a number that value investors love to focus on, but it's becoming incredibly shaky as we go through time, which is book value. Book value, at least as value investors look at it, is what your company's worth from the viewpoint of accountants. But is it? Maybe the old-time manufacturing companies, book value actually meant something. It was land and building and equipment. But if you're looking at a technology company where your biggest assets are intangible, I'm going to argue that book value is disconnected from reality. So value investing needs to get back from the wilderness. It needs to be much more open about investing in the face of uncertainty. It needs to let go of things like margin of safety when they're no longer working. And it also needs to find a way around its fixation on accounting numbers. Before I end this session, though, there's one final value investing nostrum that I want to take issue with. There are some old-time value investors who believe that you should concentrate your portfolio. Their argument is, if you got the 5 best companies in the market, why would you want to add 15? I will take issue with that. And here's the reason. When you think about what makes an investment a good one, it's because you value the company and you believe it's undervalued and you think the market will correct its mistakes. The more certain you are about your undervaluation and the more certain you are that the market will correct its mistakes, the more concentrated you can get. So at the limit, if you have valued a company and you feel absolutely certain that the company is undervalued and absolutely certain that the market is going to correct in the near term, of course you should buy just one stock. At the other extreme, the more uncertain you get about your value, because remember, you made a lot of estimates, and the more uncertain you get about whether the market will correct its mistakes, the more you need to spread your bets. I can't speak for you because you got to make your own judgment. But certain and valuation don't go together in my mind. I'm always uncertain about my valuation, no matter how carefully I've done it. And I'm always uncertain about whether the market will correct its mistakes. Given that uncertainty, I do spread my bets. I'm not going to put my money in my 5 most undervalued stocks. I'd rather do it in my 25 most undervalued stocks. I'm not suggesting you buy thousands of companies, but I think there's an argument to be made that as the world becomes more uncertain, you're grappling with more uncertainty and markets get more noisy, you should be spreading your bets more. I hope you found this session useful, and I thank you very much for listening.